It's time now for a check of the top business news stories. Brian Quinn is here from the Business Desk. Hi there, Brian.
Hey again, Tom.
Let's begin here in Europe because the EU has just slashed its economic growth forecast for the year.
Indeed, back in November, the European Commission predicted growth of 4.2% for the bloc in 2021. Well, that was before the full extent of COVID-19's second wave had been registered here. The EU now predicting growth of just 3.7% in 2021 and 3.9% in 2022. That, of course, after a drop of 6.8% in 2020. The 2022 projection, though, is actually an improvement over previous predictions, which had called for just 3% growth next year. The overall forecast is based on the assumption that lockdowns and curfews will start to ease in late spring as more and more Europeans are vaccinated. It also counts on economic stimulus measures being maintained. Here's Economy Commissioner Paolo Gentiloni.
As increasing numbers are vaccinated and containment measures are gradually relaxed, economic activity is expected to start picking up. This means, to speak in terms of the growth map, that blue waves are set to lift all boats in the EU, providing we avoid any premature withdrawal of supportive policies.
Well, next, London has lost its spot as Europe's top equities hub. Amsterdam taking over as the continent's largest trading centre last month as new post-Brexit finance rules come into effect. Some 9.2 billion euros worth of shares changed hands daily on Dutch exchanges during January. That compared to just 8.6 billion per day in London. Despite the financial services industry representing some 7% of UK GDP, it was largely left out of Brexit trade negotiations. The process of bringing newly separate UK and EU regulations into agreement, known as equivalence, is set for a March deadline. England's top central banker says he believes Europe is trying to cut London's financial industry out of the continent's business. Here he is.
Well, as is well known, the post-Brexit equivalence process between the UK and the EU has not been straightforward. Now, the EU has argued that it must better understand how the UK intends to amend or alter the rules going forwards. This is a standard that the EU holds no other country to and would, I suspect, not agree to be held to itself.
Well, speaking of European equities, stock markets here finished today mixed as a strong February rally shows signs of losing steam. London's FTSE 100 with minimal gains despite a strong earnings report from British-Swedish pharma giant AstraZeneca. Paris on the other side of the flat line while the Frankfurt DAX rose 0.75%. Amsterdam's AEX index up over 1% as it takes the top spot from London there. Wall Street treading water Thursday as investors look at a worse-than-expected weekly jobs report. The Dow down 0.25%, S&P just under the flat line, while the Nasdaq struggles to regain some ground amid a rebound in big tech stocks. Well, here in France, wine and spirits are the country's second largest export sector after the aerospace industry. But French vintners and distillers are suffering. Their international sales fell by nearly 14% in 2020 for a loss of some 2 billion euros. It's an effect not only of the coronavirus crisis that's battered the hospitality industry worldwide, but also of a tariff fight between Europe and the United States, one that shows no signs of stopping. Luke Schrager reports.
For France's wines and spirits sector, it seems there may not be much to celebrate in 2021.
On a une filière qui est déjà, comme toutes les autres filières, impactée par le Covid, puisque la première décision que prennent tous les gouvernements, c'est de fermer les bars et les restaurants au niveau mondial. Et je pense que beaucoup d'entreprises, que cette filière est constituée par des petites entreprises, des TPE, eh bien ça va être sans doute des faillites.
Amid the ongoing health crisis, 2020 saw exports drop hard to all destinations worldwide, including the premier US market. It's the largest market for French alcohol exports, worth 1.2 billion euros, but it's looking at a double hit, with US tariffs on the sector looking likely to prevent a recovery this year. The cause? A long-running dispute between Boeing and Airbus over alleged unfair state subsidies in the sector that's lasted for nearly 2 decades. The issue led the US to institute 25% tariffs on a wide range of areas in 2019, including on wine and spirits.
Notre grand risque, c'est que dans ce contentieux aéronautique USA-Europe, s'il n'est pas résolu, ils viennent impacter tous les produits importés sur le sol américain. C'est-à-dire qu'il n'y aura pas de delta de prix et que toutes les importations d'Armagnac sur le sol américain seront taxées des 25%.
with French producers fretting. President Emmanuel Macron raised the possibility of brokering a settlement with US counterpart Joe Biden last month, though the new US leader has apparently remained non-committal on the outcome so far.
Well, the French government is dropping a plan to build a new fourth terminal at Charles de Gaulle Airport here at Roissy outside Paris. French Environment Minister Barbara Pompili and ADP, the group that owns Roissy Airport, making the announcement Thursday. They cited environmental concerns as the reason, though a massive fall in aviation traffic during the global pandemic had also cast doubts on the plan's viability. That fourth terminal had been expected to serve an additional 35 to 40 million passengers annually. It faced heavy opposition from local towns and ecologists. To the U.S. next, where the microchip industry is calling on the federal government for help. Intel, Qualcomm, and AMD among the companies who sent a letter to President Joe Biden Thursday asking Washington to provide, quote, substantial funding for incentives for semiconductor manufacturing. The letter pointing out that America's share of the global chip market has fallen from 37% in 1990 to just 12% today, as foreign governments offer subsidies for chip making while the U.S. has not. It comes also, though, as a global shortage of microchips is hobbling a number of industries, particularly automobile manufacturers. Production lines idled at Ford and General Motors as chips that control key systems in new cars are nowhere to be found. Last year, U.S. lawmakers authorized subsidies for chip makers, but haven't yet ironed out the details. The White House says it's on the case.
The administration is currently identifying potential choke points in the supply chain and actively working alongside key stakeholders in industry and with our trading partners to do more now. At the same time, we are looking down the road. The long-standing issue with short supply of semiconductors, which was the question yesterday, is one of the central motivations for the executive order the president will sign in the coming weeks to undertake a comprehensive review of supply chains for critical goods.
And finally, for business, the green energy transition is widely accepted as necessary for keeping the planet livable, but it's also likely to make paying the bills much harder for oil exporting countries. A new report from the Carbon Tracker Initiative shows that 40 such petro-states are likely to face an average 46% drop in revenues over the next 20 years if demand drops in line with emissions policies and new technology. Well, that would represent budget shortfalls of some $9 trillion in 2040. The report urges oil-dependent states to diversify their economies as quickly as possible. It comes as major oil companies like Exxon have reported huge losses in 2020. Shell said Thursday it's shifting its long-term focus to renewable energies. OPEC, though, says it expects oil demand to increase through 2040. Carbon Tracker says in order to meet climate targets set out in global accords like the Paris Agreement, that demand will have to fall. The oil industry so far actually been pretty slow, you would have to say, to adapt to the reality of climate change. We'll see what actually forces the change to come down.
Yep, those petro-states better diversify, hadn't they?
They had better.
Thank you very much indeed, Brian Quinn. That's it from us. I'll be back in 3 minutes. Take it away.